but it has been, stop watching Fox or CNN or whatever you watch on great.
Thank you for joining us for another TRD Talks Live. I'm James Kleiman. I'm the managing web editor here at The Real Deal, and we've got a really great panel for you today. I'm very excited about it. So we're going to be talking broadly about New York City's office market and how companies are preparing to reopen and really what's next for the sector. And so joining me today are three of the industry's top leasing brokers and analysts. We have David Falk, who of course is the president of the tri-state region for Newmark Knight Frank. And on the tenant side, he's read big names like Havas, Kate Spade, Pace University, Major League Baseball, Angelo Gordon, and of course many others. And his team is also in charge of leasing at One World Trade Center, 1251 6th Ave, One Liberty Plaza, 299 Park, One Hudson Square, and also many others. And David has also done a lot of deals with Google and Twitter and Samsung, so you can be rest assured that we're going to be asking him plenty of questions about the tech and media sector. And we also have Nicole LaRusso from CBRE. And Nicole does a tremendous amount of market analysis on the New York City office sector. And for about a decade, she was at the Downtown Alliance. And she'll be able to talk about trends and projections and all kinds of great stats on the office market. So welcome, Nicole. And finally, we have David Goldstein at Savill. He's the branch manager of the New York office, which, of course, is tenant-focused. And he's done about $3 billion in transactions over the course of his career. And his clients include Ralph Lauren, Wilmer Hale, Jones Day, Skidmore, Owings & Merrill, Kirkland & Ellis, United Healthcare, the Government of Canada, and a ton others. So thank you all for being here. I really, really appreciate it. And, office has traditionally been seen as like a little bit of a boring sector. You have these big institutional investors and they're happy with 3-4% returns. And these blue chip companies sign huge leases for, 15, 20 years. And today I'm having a drink. This is Manhattan. And I feel like that's a pretty fitting intro to what we're going to get into today. So thanks again for being here. We have a lot of points to get through, but if you have any questions, please leave them in the Zoom section and I'll try to get to them toward the end. And before we get started, I just want to give one final shout out. I promise I'll shut up soon. Just want to thank OurXVolunteer Realty for sponsoring the event. We're able to make these discussions available to the public for free, thanks to sponsors like OurXR. So we're going to show you a very quick message from the sponsor. Again, that's OurXVolunteer Realty, and then we'll hit you with the questions in just a sec.
The COVID-19 pandemic has devastated small businesses and nonprofits across the New York region. So, how can you help? Introducing OurXVolunteer, an online platform that connects skilled professionals with local small businesses and nonprofits in need. Whether it's guidance on loan applications, legal advice, marketing tips, insurance questions, or other critical business needs, volunteers can use their skills to help the local economy recover. Getting started is easy. Visit OurXVolunteer.com and create a profile. Get matched with small businesses and nonprofits that need your help. Support your community when they need it most. Start helping today. Register at OurXVolunteer.com.
And we're back. So let us get to it. I thought it would really be fitting if we could start kind of hearing what's going on with your own offices. What are you preparing to reopen? What kinds of changes are you making to ensure that it's safe and the staff is comfortable coming back to the city? David Falk, can you share with us what's going on with your office?
Sure. So we are still waiting to hear when it's appropriate and safe, I guess, to go to phase 2, which would be to start opening up. And I think our view right now is that we're going to be very cautious, and that if someone doesn't need to be in the office, they shouldn't be in the office. We're at 125 Park Avenue, and there'll be a process in getting into the building like most buildings. I'll just say this, one of our concerns really is if someone is commuting into New York, and we're expecting to go back in shifts. So if we go back at 20% occupancy, someone's going to have to go from Westchester, Long Island, take the MTA, Long Island Railroad, or Metro North, maybe the subway, get to 125 Park, have potential screening done, wait for the elevators, go upstairs to our floor, and they're going to see it's 18% occupied, potentially with people wearing masks, and they may come to the conclusion during this interim period they may as well just not really even go in, because we go to the office to innovate and to collaborate. And that's going to feel quieter and less vibrant as we're used to. So we're going to have all the things you'd expect, which is we're adding plexiglass separators. We're going to have touchless technology, Purell wipes everywhere. We're going to have path of travel, decals on the floor, etc. But I'm concerned that what we love about our office, I'm sure Savill's does and CBRE does, is you can go down the hall and see everyone you need to see to collaborate with. And that's going to be missing in the short term.
Yeah, I look at our own office and I'm thinking maybe we won't return until September, maybe October. And when we do come, what's the point? Like if you can't really fully chat and get a feel for your colleagues and what they're doing, it's going to be a long road. So one thing that I'm really curious to hear is the discussions that you guys as office leasing brokers are having with your clients right now. David Goldstein, maybe you could share, how many of them are looking to downsize or renegotiate, or are any of them getting out of their leases? What does your day look like these days?
Sure. Look, it's complex and obviously very situational. Every tenant has different needs, and I think it's also very industry specific. It's very clear that the retail industry is amongst the hardest hit. Putting aside restaurants and mom and pop retail, which are by far the most affected parts of our community, you've got the major office users who have basically gravitated towards a high density floor plan, promoting high levels of interaction and bringing people together. And now we're in a moment where people are being pulled apart. So there's a lot of data to unpack, and I think it's way too early to make long-term decisions. So as a result of that, you're seeing the pace and velocity of major transactions sort of slow to a crawl. There are a couple of exceptions, but for the most part, unless there's an imminent expiring lease, there really isn't an acute focus on an immediate plan. I think it's more about understanding organizationally, what will I be? This incredible organism that I am, or that I was, let's say, just 60 or 90 days ago, what will I be going forward? And how do I create precautions and build confidence to reimagine what that workplace needs to look like going forward? And I think a lot depends upon sort of the emotional state of the employees when they return. I think most are being more cautious about the return, hoping to not find themselves in a situation where, to David's point, the employees come back, it's not as inspiring as everyone had hoped. There's a variety of things that can go wrong along that continuum, from the commute into the lobby, up through the elevators into the workplace. So I think it's a slow and steady analysis of what the healthy workplace should look like in the near term. And I think on parallel with that is a track towards the workplace of the future and how to continue to unlock the big and beautiful and brilliant ideas, while people are likely going to have a propensity for being not together as much as they were in the past.
We already saw, though, that the tenants were taking less space than they had previously had in old leases, right? So a company that had 100,000 square feet that they signed for in like 2005, they're maybe down to 75, 80,000 if they're signing big leases today. Nicole, do you have any sense of what's going to happen in the immediate, next few quarters in terms of volume, in terms of, price per square foot on deals? Do you have any numbers?
Sure. Yeah. No. I think generally the big question now is what are my immediate needs, and then the long-term question. And I think immediate needs right now, if everyone is working from home for a prolonged period, as we just discussed, and I think that's right, people aren't going to come back to the office unless they really need to, until the commute can be safe, until the workplace can feel more normal and the basis for being there is restored, meaning there's lots of people there to collaborate with. And so in the short term, we're seeing, it kind of feels like a frozen market where we're not seeing anyone really make long-term decisions and even some short-term decisions. It's not clear what the needs are for the short term. People are, getting by working from home, and that's been okay for now. But do we want to bring people back into a workplace that's not 100%, up and running in a normal way? And do I need to change my real estate footprint in the short term to address that? And I think, interestingly, there's been a lot of discussion of, companies might not need as much space because they're going to transition to a more permanent work from home solution. I think that's a lot of speculation at this point, some good questions being asked, but I think it's hard to determine if that's a long-term trend. But on the other hand, we're also talking about, well, maybe we were already packed in a little too tightly before this happened, and now this is just one more thing that's going to encourage us to spread out a little bit. And certainly in the near term, we might need more space per person, and therefore some of those tenants that are even perhaps cutting back on their workforce might find that they still need the same footprint, at least in this interim period, to allow for more space and social distancing in the office and to just let people spread out a little bit more. So I think in the short term, it's really hard for tenants to make a decision. And we're seeing that in terms of volume in certainly at the end of the first quarter and early into the second quarter, there's really been very little leasing activity. Also, interestingly enough, there's been very little additional space put on the market, both in terms of sublease space, which is something we're all anticipating and looking at closely, but also even just regular additions to space have been a bit muted relative to what we'd expect in other quarters. And I think it's just, there's no rush to put space on the market right now when no one is really out there making decisions to take space at the moment.
Is there anyone who is brave enough right now to be leasing space? David Falk?
Well, I mean, as David Goldstein said, we're finishing up some transactions, as others are, for tenants that pre-COVID had a lease document out with a lease expiration, so they needed to make a deal. Other deals we were working on that had an exuberance of job growth and projection of hires, those are now all on pause. So I think the ones that will have happened need to. I think what will be very clear is in the third quarter, the market's going to show statistically a low amount of done deals because we're now in the second quarter finishing deals that were already in the works. It's hard in this time period to collaborate and get people going to start thinking about a new business or look for new space when they're not even sure how long this
right, like where's the bottom? How do you make a long-term decision if you don't know what's going to happen? And
so I think what you'll see, and I'm sure Nicole and David, you're seeing this, we're going to see a lot of short-term kick-the-can renewals just to live for another day, not make a long-term commitment until they have clarity.
Right, and David, that's not always a perfect science because some leases that are expiring have renewal provisions. The traditional methodology is 5 years or 10 years, and I don't think there's a tenant out there that can project with great confidence what their space needs are going to be going forward. So that's why having proper relations with the sponsor, I think, is key, and those relationships will go a long way towards unlocking some temporary solutions while we all sort of start to build a new roadmap with confidence that will allow those negotiations to pick up and take place.
And so on that note, are we seeing discounts in any of the space that maybe a deal was in negotiations? There was a rough accord that was struck, and now the tenant says, what am I doing paying $85 a foot for a space that maybe I don't need all that space?
We've seen, and David, curious, sure you've seen some too, but certain transactions that are in progress where in an attempt to get these deals over the goal line, the landlords are offering some additional incentives in the form of rent abatement or TI concessions.
Yeah. You're
not really seeing the base rent needle move much. In some cases, there's some movement, but I think price discovery is a challenge for all of us going forward to understand what those dynamics will look like, and every building and every developer is going to have a different set of guidelines and methodologies to follow in order to figure it out. Don't forget, it's not just the sponsor, it's the lender, and there's a capital stack. In that capital stack, there's often a loan. The landlord still has to pay real estate taxes, which are coming due in July. They've got to pay debt service. So it's going to be a Rubik's Cube of sort to figure out. And I think that's why everyone is Zooming 24/7 in an attempt to try to be part of the solution.
And by the way, David, I would say if it wasn't for Zoom, you have not worn a button-down shirt in 10 weeks.
Look, my Grateful Dead t-shirt is on underneath, okay? So
I know you.
Exactly.
I think to that question of price discovery, I just add too, I think, when we've been thinking about how this economic situation will play out and what that means for the impact ultimately on the Manhattan office market, we've been looking at historical precedents and thinking, how is this similar or different? And our house view is this is in a very different situation than what we saw certainly following 9/11 or what we saw during the Great Financial Crisis, where the impact was kind of slow rolling on the market and it took many quarters for it to really play out. Certainly in the case of the financial crisis, the market continued to go down in terms of lower demand and pricing for several years, really, and then had a very slow trajectory coming back out of that, where this time around, and we look at examples from Asian markets where we get some good insights, but we're expecting, and obviously we're all living through this very brutal, quick, and painful period of job loss and economic decline. But then we really expect that to start turning around in the third and fourth quarter. Certainly we wouldn't, the market might take a while to respond to those economic conditions. But the good news from that perspective is that it should be a shorter duration of the impact and hopefully return, so we can sort of hit the low point in terms of pricing within a year or so, and then start to return back to more volume and transactions in the market, jobs, coming back from jobs that they might have been furloughed on or rehiring, and then that leading to more leasing in the market to kind of stabilize, so that this sort of trough won't be as, it won't take as long to get there, and it likely won't be as deep as what we saw in prior periods and prior crises.
Are we seeing any, if you look at the Hong Kong office market, is it showing signs of rebounding at all, or kind of where are they? It
is. And every Asian market's in a slightly different place, and there's, a little bit of rebound effect here and there. But some of the great insights that we're getting from our Chinese offices is to show that the leasing activity in terms of the number of tours that we're booking with clients to go back out and look at space is really starting to pick up, and that's a good sign. There wasn't a dramatic drop off in pricing. And we've been able to kind of regain some of that. So I think both of those are good indicators. Obviously, the United States is a very different place, but I think good signs ahead for what we might expect this time around, and how it is really different than some of the other things we've seen before, where you had like a very difficult sort of structural imbalance in the economy that really made it difficult for us to recover. And so hopeful that this trajectory of quick loss, but also major stimulus will allow companies to get back on the right footing in the not so distant future.
Because you brought it up, I'm really curious to know, what does a virtual office tour look like these days? Are you guys doing them? How are you, are they being done? If so, are they effective?
So I'll take a shot at that. For years, I think we all laughed at them. We just didn't think they were, who's going to look at space virtually? But I know personally we've done some things internally at Newmark where if David Goldstein called me and said, I have a great tenant looking, and I'm looking in Midtown Manhattan, and I sent him the virtual tour of one of the buildings that we have just completed. Our goal is for him and his client, who's based in Chicago, to not have to fly here and to fully understand the magnitude of this building, the tenant roster, the floor plate, the views, and with Matterport technology and great software, we now have the ability to really give someone, instead of them seeing 25 buildings and wasting 4 days, they could pre-screen these and shortlist the buildings to 1 day, 5 buildings, and then they can make a decision. So it's gotten so good, they could actually work the whole floor, see every crevice, and say, I like it or it's not for us.
Agreed. There are incredible tools out there. There's no substitute at the end of the day for walking the site and understanding the nuances of one building versus the next. But I think this technology can get you, 80+% of the way there. And it's not just technology for tours. It's also, I think, the pace of technology innovation has accelerated in just the last 90 days. People really, the pace of decision making is going to accelerate, and as a result, I think we're all going to find ourselves searching for great technology tools to kind of further the reemergence of the industry generally. They're incredible.
What kind of tools are you guys using? I heard David Falk, you said you're using Matterport. Are there other like new tools that maybe had been out there but hadn't been fully utilized until the pandemic struck that you're relying upon increasingly?
So we've been using Matterport, but I also came across a product last week where if I'm the agent of the building and I send to the Dave Goldsteins of the world our tour, while Dave is viewing it, I could actually talk him through where he is on the floor as if I'm giving him an actual walkthrough of the building. So you don't want to just send someone a virtual tour and they don't understand the history of the building or how it was built.
You need a narrative.
Right. And I think that's actually a really good addition to it. So now it fully completes the experience.
We're experimenting with fly-through technology that does similar things to what David's describing, sort of bird's eye views of central business districts that are able to help us analyze where the availabilities are, where the expiring leases are, and sort of bringing some context to what was formerly done, paper, pencil, and crayon, so to speak. There's great stuff out there.
It's sort of an interesting parallel to this idea of omnichannel and retail, right? It's, I think there was this idea that technology and e-commerce would completely replace the in-person shopping experience. And what we all learned is that technology enhances that regular shopping experience and kind of makes it more seamless and more integrated. And I can see how these virtual touring tools will just make that whole process of finding space and touring space and making decisions better. But it'd be good to combine all of the tools that you have, not to rely on one or the other.
All this being said, I think the longer we're sort of maybe in the middle of the frying pan, so to speak, right? We slid off the edge, we're making our way across, and it seems to have gotten a little bit bigger. And eventually we're all going to climb up and do our best to get back to whatever the new normal is. I feel like as our timeline has grown, I think the yearning to get back and to do things in person with one another, maybe it's on a different shift in schedules, maybe it's a couple of times a day at first. I think that's all going to be essential to bringing life back to the system.
So can I just, James, can I just ask a question, maybe following up on David's point? Because we haven't really touched upon that much about remote work. And I was on a phone call today with someone who said something that I hadn't really thought about. We've all talked about the de-densification and thus there'd be a percentage that may stay and work remotely. But the person I was speaking to said she's in a one-bedroom in Manhattan. She's been there for 10 weeks. Her apartment is not set up for her to work from home. She misses being in the office, seeing her peers, her colleagues, but it's not comfortable. There's no place to set up for it. And so, I think we do forget also that it's a part of our lifestyle of being in the office. And yes, there are jobs like coders in technology who have headphones on all day. They could probably code from a studio or someplace where they don't have to do anything but sit at a computer. But I don't think it's as simple as saying, well, these last few weeks have been very effective with technology. You can keep doing this. The responses we're seeing are that it's not set up for the lifestyle to be 24/7 in the same location. I'm curious what you guys see.
I think that's a good point.
No, I think you're very right, David. And in fact, we've done some surveying of our clients and their workforces, and it's mirrored what we found in surveying our own workforce, which is to say, particularly young people, younger than me, certainly, that are the most eager to get back into the office because, A, their home situation is not ideal for continuous remote working, but also they're really looking to build their skills and to build their connections and to mentor and learn their job. And that's a lot harder to do through a screen at home all the time. What they want is that opportunity to network and grow and collaborate, I think even more so than some of the rest of us who are a little bit more in our groove maybe, and it's a little easier for us to work remotely. But I do think it's really that those younger workers in particular who are more ascended in their career who really miss what the office environment provides them.
So all of that may be true, but at the same rate, I think it was just last week that we heard Jack Dorsey of Twitter saying, in fact, nobody has to come to the office this year or ever. And so I know, David Falk, you've worked with Twitter before. I think you helped get them their big space in Chelsea. Is this policy, the work from home indefinitely, is this going to catch on? Is this going to be isolated to certain sectors like tech and media? Or will this be embraced? And what does that do for the landlords in Manhattan?
So, well, first of all, when we did the Twitter deal, we represented ownership on that deal on 249 West 17th Street, but it was very similar to most technology firms. They wanted that open environment. I think it comes down to the industry. One of our clients is a major accounting firm. They said their technology is so good that they're able to have all their partners work remotely, get the tax returns out. That kind of makes sense. But, when you think about the young workforce, as Nicole was just saying, they want to learn from others. They want to they have mentors. They want to every day be a sponge and absorb. You can't do that just sitting home. So I think it does depend on the industry, and there will be a percent that can effectively work remotely. I think that the one thing we've learned about technology and being remote is I do think this will affect corporate travel, because to fly across the country for a 90-minute meeting to go from New York to the West Coast when you can do it on Zoom, maybe it's not perfect, but it saves a lot of time and money.
That's a good point. I do wonder, though, what does this mean for the landlords? If you're the landlord in Twitter right now, and Jack Dorsey says very publicly to the whole world, you know what, none of my workers need to be here. Does that mean he's looking to renegotiate the lease, just sublet it, and it's not my problem? What are you thinking if you're the landlord of that space?
I'll interject here. I think the bigger question is, what will the employees opt to do when they're not in a period of duress in making the decision? What will the sentiment be? Let's just look forward to September, October, when presumably, let's all be optimistic, we're searching for a vaccine, there will be tracing, we'll have new safety standards in place. People, we think, will want to return to the workplace. In what capacity? We're going to find out. I'm not so sure that all the let's just pick on Twitter for a moment, that all those very creative, sort of big idea, community-minded people want to work isolated on Zoom calls, with drop cell service and their dogs nipping at their heels. I feel like it's manageable and some people are enjoying it, but I feel like it can be woven into sort of part of the narrative. And I feel like going forward, as you reshape your experience as a worker, it has the ability to sort of become a little more, like a bit of a pie chart in that, you'll spend X percent of the time in the office, X percent working remotely, and then there'll be hybrid moments where you'll come in to collaborate with teams, and maybe you'll even get more done at those moments, at those events, whatever those venues are, because they're so concentrated and purposeful versus, unfortunately, some of the unintended collisions that likely won't take place as a result going forward because of the distancing needs.
One question that I have, though, is what does this mean for flex space? Does it turn any large landlord who has a lot of office properties across Manhattan, in other areas even, does that allow them to be a competitor of say, Hotel or Convene or Industrious or some of these so-called flex space providers? What is the future of flex space today?
Well, I certainly think landlords are already competing with flex space providers. And so there's a lot of new dynamics at play right now for that whole industry, certainly cash flow issues and people taking advantage of those flexible terms that they paid a premium for. That's certainly going to show up in the revenue of a lot of the operators into the foreseeable future. On the other hand, when there's more uncertainty, the value of flexibility goes up. And so overall, the business model for the desire for flexibility and the willingness to pay a premium to have it, I think endures. I think we feel pretty confident that that's true. Individual operators will have their own struggles with their own cash flow issues and obligation issues that some will or some won't make it through. But I think landlords have already been feeling the pressure from flex space operators, particularly those who are doing a good job of attracting the smaller enterprise users, but smaller tenants. We've seen a real decline, pre-COVID, we saw a pretty consistent decline over the years in the number of leases done by tenants of 5,000 square foot and lower. As the flex footprint in New York grew, the number of deals that went direct to landlords was declining. So there really is a relationship there. And I think landlords have been thinking a lot about how do they participate more in this market. And if tenants are willing to pay a third party extra dollars per square foot for flexibility, well, maybe they'd be just as willing to pay the landlord for that too. So we've seen a lot of dabbling and experimenting with those different business models. And I think this new experience that we're all living through with COVID just provides even more opportunity for that, as some might be getting the keys back to some spaces that are really set up for flex space. Although I think that you're going to see more interest in the office suites and enterprise user model than the pure co-working, which has all the challenges of densely packed people and
premised on density.
Yeah, unpredictability. So I think there's definitely, it's a very dynamic situation right now in the flex space landscape in New York.
Just to add to that, the co-working is about density. And so the flexible office space industry is 18 million square feet in Manhattan. And a good portion of that is co-working. And if they can't have the densification, they have to have social distancing, the model is not going to work, which will mean more space will come back to the market. Just one other thing, though, about it, which is, I think, kind of interesting trend from a positive standpoint, we're seeing a lot of requests for clients of ours to ask in the suburbs for this temporary space just to get through this period. So this flexibility in Greenwich or in Rye, for someone to say, I need 20 people for 18 months, again, it's all under this flexibility, not long term, but the reason is they want to put people together. They don't want it to be remote. They want them together, but they don't want to right now deal with getting into the city because there's no answer yet for the MTA situation.
Right, and that's a really great point. That becomes a long-term trend that has the ability to move the needle, as it relates to the supply and demand dynamics of the local marketplace. No question.
Does this mean, there are companies, big landlords and developers like RXR, who made big bets on the suburban office markets out in Long Island and, Westchester and Connecticut, and it looks like a pretty smart bet today, which brings me to the next question, which is, I think I have been looking forward to the Brooklyn office market finally having a moment, finally developing. Are there areas outside of Manhattan that stand to benefit from a shorter, medium-term hit to Manhattan's office stock?
I think a lot of that I'll start. I think a lot of that goes back to the transportation network and how comfortable employees feel about accessing these locations. Some of the roadblocks to some of these redevelopments or developments that have been either conceived or gone into the ground and been built has been, some are just better located than others by their traditional methodology. I think you might see a different emphasis on, shuttle buses, driving, other forms of, whether it's a ferry, to a bicycle during seasonal, times. I think a lot of different methodologies, depending upon what industry we're focused on, that would allow some of these maybe more, some of the, what was prior to this maybe classified as a more difficult location, maybe becoming a little bit easier to get to, and maybe something that's right above a transit hub isn't necessarily deemed as being ideal right now.
David Falk, I know that I think you're the leasing agent for Industry City and for Toby Moskowitz's 25 Kent. Do you have different projections now? Is there reason to think that the market's changed for you guys?
Well, we're not involved in 25 Kent. So, Industry City is it's probably the best economic alternative out there. It's almost Chelsea Market-ish community that has a vibe, and it's really well priced. So, I think for all of this, we're going to learn a lot of the next, really the next 8 months to see what people want when they come back. And, will they want a less dense environment? Are they going to ask for changes so there's less community? That's, when you think about Chelsea markets of the world, that was based on community. Industry City followed that pattern, but I think they'll do just fine.
Nicole, I wanted to ask you, it sounds like a lot of the Class A office space providers, they're big pension funds and hedge funds and institutional investors. And even if they don't get their 4% return every year, they can probably weather, a pandemic. But for the landlords of Class B office space, chances are their tenants, they're not blue chip. They may not be able to pay the rent. They may not pay the rent at all. And they probably can't retrofit their offices, to make it sort of like work in the age of COVID. What are their options? Are they in a bad spot right now?
I certainly think from our perspective, we've seen the flight to quality was a trend that's been going on pretty much through this entire cycle. So the best buildings in the market are getting the lion's share of demand and the best pricing, and other buildings that are less well equipped were having more difficulty, more competitive environment. Certainly a lot of negotiation on rent and TI and free rent and so on. And I think that just gets harder now, right? Especially when the speed and the service of the elevators and the HVAC functionality, all of that becomes that much more important. The security systems, all of that. So I think, again, it was already sort of challenging for those owners who did not have the best quality or close to the best quality space in the market. And I think that environment just gets harder. And how much capital do they have to put in really to remake those buildings, or even practically speaking, how much can you remake them? It's not obvious how that those turn out. I think there's a lot of challenges for those assets right now.
Definitely a sector to look out for in the future.
It will allow for some new forms of pioneering as it relates to the B&C product, to think of new ways to redevelop and reinvigorate those assets to bring them up to modern day standards. There's conversation around the value of second floors because tenants take a stairwell up to their entry and bypass the lobby. Might private entrances become more important for companies that want to contain the entry experience to their visitors and their employees only? Might there be conferencing facilities on the ground floor so guests don't have to go up into the office tower? There are a lot of different ways to go about this. And what's always nice about New York is it's a massive market. It's constantly evolving. So many different asset types that I think it's going to it'll be an exciting journey to reimagine how tenants are allowed to think of new ways to occupy and be visionary about creating sort of breaking down the barriers that are being presented to us as a result of this catastrophe.
So I wanted to get on the favorite of the brokers, which is commissions and sales and making money. Investment sales brokers are used to going a few months without a lot of money coming in. But typically my understanding is that office leasing brokers are used to more consistent income. But if leasing activity remains really low, if the market remains frozen, are we likely to see a contraction of the office leasing broker? Or are there going to be fewer of them? Are they going to move to different areas? Anyone can jump in on this.
It's the first time I've ever been asked that question. I would assume that if the market continues, you'd probably see golf handicaps go down because people have more time to play golf. Potentially more divorces, not personally speaking, of course, but in general, there are people that maybe have relationships that they have to deal with. I think this will take patience because if you think about it, if the job market is difficult for younger brokers, let's say right now, and they were going through a difficult time, they just need to understand that we've had a very good X amount of years, and once there's a vaccine, we're going to get back into the groove that we had, and we're going to move forward. And we're going to need patience until we have a vaccine, and those that are in the business need to understand it's a long-term business.
I think in our shop, of course, I'm not a broker, but I spend a lot of time talking to brokers and working with brokers. And I think one of the things that's been really important at CBRE is for the younger brokers who, it's already a challenging environment for them, that these more senior brokers are there to say, we have been through crises before, and we will come out of it, and to sort of be there to let people understand that this too shall pass. And that seems to be maybe hard to envision at the moment for people who haven't been through something like this before. But when you have my colleagues on this panel with long careers could attest to, right, you go through up and down, and certainly there are some lean times, but then the market will come back. So just have to power through.
James, I look at the question maybe through a slightly different lens. I think this will be a moment of incredible opportunity. I think that, major users will have the ability to dictate, far better terms than they've been able to in prior cycles. There will be, the disruption always creates opportunities to reimagine occupancy. And I think that, you talk about, the velocity of transactions. It's really, now's a great time to be sort of using this training camp as a way to break new ground and develop new strategies about ways to serve your clients better. So, of course, we all have to be patient. And I think that, structuring long-term proper transactions takes, they have to be handled with a great deal of care. And as a result, I think you're right. I think that the horizon might be a little bit longer, but I think at the end of the day, the clients will be better suited as a result of the strategies that were hatched in this period of time.
Certainly seems good for the tenant side of the equation. I wanted to get to a few questions from the audience. We have a lot of really good ones. This one comes from Howard Stern. I don't think it's actually Howard Stern. He or she writes, but as a landlord, C-suite executives now have learned that work from home does work, which they've been resisting for many years from HR. Should I be concerned about future absorption?
Again, I can just start by saying, I think it's really, I know there's a lot of hot takes right now about, this is the end of the office and now nobody needs to be in the office. And I think we're all very lucky that this remote experiment has turned out better than we might have anticipated. But the reality is that we could have been working remotely before this happened, and we made a choice to be in the office because there are some real benefits to that, which I think we've already touched on. So I think we have to kind of get through this interim period, this difficult period where we're confronted with bad news and we're wondering how we're going to get back into the office, and some of the questions and things that haven't been resolved yet are still in front of us. But in a year or 2 years from now, a lot of the biggest challenges of this will be behind us, and the value of the office and being in the office together will be more front of mind than it is right now. So I feel pretty confident that this is I think certainly the curve might bend a bit in terms of how much space we need per person and what overall percentage of the workforce is in the office 100% of the time. But I think the value of being together, collaborating in an office will endure, and that will be good news for the office market in Manhattan.
I'm really curious about the idea of new development. Like, is there anybody crazy enough right now to develop on spec an office building or even just an office building in general? And if so, what does the construction look like? What is the design? What is the layout? Do the numbers ever pencil out? Would a bank ever say, sure, here's your $600 million? Go for it.
I don't know if anyone's running to finance it right this second, but again, I think 6 months from now, 12 months from now, 18 months from now, the market will feel very different than it feels right now. And I think things will feel more normal than we might anticipate at this moment.
James, I think you'll see development. It may be more bespoke in nature and tailored to the needs of the tenant, and it might involve smaller sites that can be activated, let's say, to accommodate 300,000, 400,000, 500,000 foot envelope, where the tenant can have presence, their own entrance, control the environment, have the outdoor spaces and the other sort of modern day amenities that a tenant might require going forward. And we're trying to figure out what those might be, because certainly that whole landscape is going to change. But I think the new construction has a lot of advantages, and I feel like the city's going to endure. The occupiers will come back in a different form, granted, maybe not as massive as they were in the prior cycle, or as dense, of course. But I think you're going to see some bold candidates emerge that are well-financed, that have a confident workforce, that want to be back, but also want to have a very special facility at the right price. And this will be the environment to accomplish that.
So, James, just to add to that, the average building commercial building in New York City is 86 years old. And when you look at Hudson Yards, which is a tremendous success, the reason for its success was when someone would go and see what they can get for new construction, all the benefits, the efficiencies, the infrastructure, the column-free nature, the ceiling heights, the forward-thinking statement it made, and the cost per employee actually wasn't as high because of the efficiencies, it made sense. I think going up on, if you came today and said, I have a project to go on spec, I agree with Nicole, it's going to be hard to get financing for it. But there are projects that are in the works now that are being built. And, when they're finished, they're going to see demand. The question is, will there be an adjustment in rents? It's too soon to know that.
We did within the last few months see, I think it was something like, I heard the statistic, it was like $5 billion of market value has evaporated from SL Green and Vornado, two of the biggest office providers in the city. Is that a bad omen? Are there good reasons to believe that this is not a town to invest in right now?
Listen, I think all three of us have said that we think for the long term, you have to believe in this. I think one thing we haven't spoken about, which is something that is part of the experience, is that over the last 3 months, New York City has changed. The retail is closed up. The restaurants are shut down. And we come back, whenever that is, in 3 months or 4 months, we may see a different short-term Manhattan. And that's why there is a little black cloud hanging over this, because you're seeing a lack of vibe, you're seeing a lack of streetscape, you're seeing where special that Manhattan won't exist in the same way, and it's going to take a while to come back. So all of this is going to be a process of getting back.
I wanted to check in with one anonymous attendee who asks, any advice for a recent grad getting into the industry? Will some sectors within the industry be more likely to add, say, landlords versus brokerages versus asset managers, et cetera? Dave Goldstein, maybe you could take a crack at this.
Sure. Look, I'm incredibly bullish, about the industry, and I feel like, I joined in the late 80s when the market was in a very rough place, and I think learning with the right mentors and the right tools and the right attitude when the markets are a little chaotic is probably not the worst thing. And I think, the modern day real estate professional has to have a lot of different skills. It's not a sales position. You've got to be analytical by nature. You've got to be measured in your approach to risk. You've got to be intelligent as it relates to all the advanced analytics that shape how deals get structured. So I think it's a great time to get into all aspects of industry. But it just, there's no quick fix and there's no quick hit. This is, we're all playing the long game. And there's nothing easy about anything that any of us do on this call, the four of us. And I think anyone that has had success in the industry will say the same thing.
What's unique about this industry, which is kind of fun, every deal we do, I have a counterparty. So if Dave Goldstein is doing a deal with me, we obviously want to do the best for our clients, but it's nice to have a trust and respect for each other, because no one wants to be embarrassed. And this is a business of respect. It's a camaraderie, it's collaboration, and it shouldn't be about what cycle you enter the business in. I run a team of 12 people, and I think it's the most special environment that exists, and it's because people, they collaborate together on a daily basis, and they work together as a team. And the joy you have when you have success and you fulfill your clients' objectives is really what it's all about. So if that feels right for you, that's the right business to go into.
Good luck, whoever you are.
You call Dave Goldstein.
Here you go. He's got a job for you.
2,000.
It may not pay as great in the next quarter, but stick with them. So a lot of the big office landlords, they're mostly passive. They're these big hedge funds or sovereign wealth funds or pension funds, and they've typically just hired a management company to do all their dirty work. Are they going to be more active now that they're no longer guaranteeing 4% yields to their investors, or are they going to be even more so just letting other people handle all the work?
Nicole, you want to attack that?
Yeah, I mean, I think, look, that, I heard, I think it was Oxford on a similar call not that long ago, and they certainly said, we and everyone like us has just seen the value of our holdings diminish, but that makes us even, more focused on where the best value is, where the best long-term return opportunities are. So I think they're certainly very focused, and they need to get returns for their constituents, and so they're very focused on how they're going to do that in a more challenging environment. Although, of course, there are opportunities now too for well-funded, well-capitalized investors. So there's definitely a lot going on there. But I think now you have to be even smarter about how you manage and operate your building, and you need really good partners for that too. So I think at all levels, everyone has to be at the top of their game to get through a difficult market.
Right, is the operating side of it, the CBREs and Cushman & Wakefield and JLL and Savill, are they going to be doing more, or are they going to be spending more of their capital just managing these assets for these big investors?
I know that some of the operating costs are going to go up in the short term, right, with all the extra cleaning that we're doing and the enhanced HVAC system. So there's definitely going to be more expenses. I think everyone is going to have to spend a bit more to manage and operate their buildings through this. I'm not sure about the longer term in terms of our investment as a company.
Mm-hmm. Cool. I've got one final question, and this is more of a news you can use. This is another anonymous attendee, David Falk. The question is, what is the name of that virtual tour product that you brought up before? I guess this person wants to buy the walkthrough software.
Well, we actually created it in-house. So we use Matterport. Matterport is the technology we're using for a 3D experience. You can really walk through the entire premises. And then we work with a developer that we've created an experience. And if they want to reach out to me, well, we can show it to them.
Okay. I think maybe Matterport should sponsor our next event. Well, this has been great. Thank you guys so much. Really appreciate you having me, being with me today. David Goldstein of Savill, David Falk of Newmark, and Nicole LaRusso of CBRE. And we do these every Monday, Wednesday, and Friday. And these are about 45-minute conversations. The one thing we ask is that if you don't already, please subscribe. It supports the journalism, and it helps allow these products to be free for all. So,
hey, James, did you finish your drink?
Not quite. But it's a long road to the Manhattan office market. So we've got some time, and I'm optimistic now. So I was a skeptic before all this.
Thank you. See everybody.
Thank you, everybody.
Take care.
Thank you.
Take care.